The week ahead looks set to be dominated by Monday's inauguration for Donald Trump, and there's still big question marks about exactly what he's going to do and what the impacts will be on markets. So it's going to be a big week anyway, but alongside that, we've got the likes of the BoJ interest rate decision and a raft of data out of the UK to continue the theme around borrowing costs and the trajectory of interest rates at the Bank of England. So let's get into it. First and foremost, here are the big ticket items. According to Trading Economics, you can see that Monday really is all about that inauguration. I've provided a separate video to this, which has a bigger view on how we could see Donald Trump's initial stint as president impacting different markets, the likes of the FX markets, the indices, the likes of gold, oil. So make sure to check that out on the account. Other than that, of course, we'll go through it a little bit here, but more talking in relation to the US dollar. Then Tuesday, we've got the UK jobs report, as you can see here, coming alongside the likes of the ZEW economic sentiment out of Germany and the inflation rate out of Canada. Then that focus on Japan comes, balance of trade on Wednesday, inflation rate on Thursday, and then on Friday, the BoJ interest rate decision, coming at a time when we're questioning whether we're actually going to see more rate cuts from the likes of the Fed and the BOE and the ECB. It's the BoJ that looks set to raise rates and move in the opposite direction. So the possibility of Japanese yen strength coming into play there. And as you can see there, we've also got some PMI data coming out on Friday. So first and foremost, we want to talk about the US. There's other stuff happening over the course of the week, most notably Friday's PMI data. But really, it's all about Monday's inauguration and then the follow-up from that, right? So there's a feeling that this time around for Donald Trump, he's going to be better prepared for the beginning of his stint, and that he's likely to move in a more swift manner. Certainly, we've seen moves in the crypto market in the lead up to this, with people speculating that we could see some sort of major announcement there. And it feels like everyone has their own vested interest and hopes that he's going to enact something that might benefit their asset or their investment. Quite what he's going to do remains to be seen. Certainly, there's a lot of hesitation and caution recently because you saw that initial massive run up in terms of equity markets after he took both sides of Congress. And then we see this pullback where a lot of that was erased and markets started to think, well, actually, if we're starting to see a reflation move coming into play prior to him even stepping into the White House, what's going to happen when he comes out with stimulus measures, pro-growth strategies, the tariffs being implemented? So there's a significant amount of concern within markets that has been allayed significantly by that CPI figure that came out recently with a move lower, notably within the core number. And in actual fact, that CPI and inflation report really highlighted the importance of energy as we go forward. Inflation, as driven on the headline metric, came in higher as expected, but higher. And that's driven by higher energy prices. And so Donald Trump's sort of drill baby drill thing, that's going to come into the fore. He needs to really start to turn on those taps and drive down energy prices. And that could be the thing that really helps him to allow him to do other things that may be inflationary, but maybe are being undermined by that downside in terms of energy prices. So he really has to do everything he can to drive down energy prices. Certainly when it comes to the strategic petroleum reserves, there's not much left in the tank because Joe Biden already used that trick. So it's really going to come down to making moves within the oil and gas sector to try and incentivize people to produce significant amounts more oil and gas to be able to bring down prices. That's going to be absolutely key. Whether we see something on that front will be notable. And of course, we're going to be looking out for a whole host of other things. But certainly what we have seen since he's come into power is this move higher in terms of the US dollar. And that's what I want to focus on, right? A lot of that came alongside this view that we're going to see higher inflation from Trump. And therefore, there's a perception that we were going to see less and less rate cuts in 2025. The Fed priced in 2 rate cuts over the course of the year, according to the dot plot. Markets then said, well, actually, we think there's only going to be 1. But that has started to reverse a little bit. And notably, what we see in terms of inflation and in terms of announcements from Donald Trump will really help or hinder that fear around reflation. because certainly if Trump comes out and his policies are all stated with a view to constantly considering inflation, then that would be a good thing. If it feels like he's just coming out and he's just coming out all guns blazing with his policies and he doesn't really care whether inflation rears its head once again, that could be the kind of thing that drives markets down. It could drive the US dollar higher once again. But certainly, if we're looking at things like tariffs in the past, he has enacted tariffs and we didn't see a massive surge in terms of goods inflation. At the moment, goods inflation is largely benign. It's near enough non-existent, and services inflation is the problem. But that actually came down in the latest inflation report. So there's some good news here. The question mark is, will markets take his initial policy announcements as inflationary or not? And that is likely to drive the US dollar. As we can see here, when he first came into power back in 2016, post 2016, we saw that initial bump, just like we've seen in terms of the US dollar. And the question mark is whether that's going to persist or not. You can think, he's good for the markets, he's good for the economy. Well, good for the markets tends to be bad for the US dollar. But that hasn't been the case recently because people are thinking that the US is standing out from the rest in terms of this reflation move, and therefore we could see the likes of the Federal Reserve holding off at the same time as, say, the ECB. And remember, the dollar index is heavily weighted towards euro dollar in particular. Well, the ECB is going to continue to cut rates, is in a better position in terms of driving down inflation, and the economy is in trouble, so they need it, right? Whereas the US, the economy is strong and inflation is a potential problem. And so how that inflation picture resolves itself is going to be absolutely key for the US dollar. So this is that sort of outlook and that blueprint. Do we see him come out with things that make people worry more? Or do we see Donald Trump coming out with things that make us think, actually, he's considering the inflation picture and he's doing things, most notably within the energy market, that could essentially drive inflation lower because it's the headline inflation figure that really started to move towards the upside over the last metric. So as we can see here, this is the dollar index rise that we've seen over the course of this period post-election. You can see the election was back here. So we've seen that rally. The recent pullback's taken us into the 61.8. So you can't necessarily say, this market's topped out. And certainly as things stand, it remains bullish. And if we're looking at the sort of short-term implications, you can see the sharp pullback, that long lower shadow, long lower wick. And then we've been sort of bouncing around this area, sort of haven't really got a lot of conviction in terms of direction. What we have got is higher lows here, though. So certainly if we were to break up through this resistance zone that is 109.38, then you look like you've potentially bottomed out once again and the bulls are back in charge to continue this bullish trend. That's if he comes out with, let's just get rid of that. That's if he comes out with announcements that are perceived to be inflationary by nature. If he comes out with something that is perceived to be considerate of inflation, and in particular, if it comes to the energy market, something they think will actually do the job in terms of driving down inflation, you've got the possibility of this rolling over. And certainly the key thing here is, do we break the 107.750? If we do, then it looks like this recovery is done and dusted. But you can see we've broken out from this consolidation phase, set within a long-term uptrend here since the lows in 2007. So as it stands, it looks likely that we're just going to push onwards and upwards. But it really comes down to whether the US will see a reflation move or won't under Donald Trump. And certainly this initial period is going to be absolutely key in terms of sentiment. And obviously it's sentiment that leads the way before data itself. Data is the most important, but it takes time for that to come through. And therefore markets just make their best guess based on what they're hearing at the time. So Donald Trump's initial stint is going to be really important for that sentiment side of the picture. Next up, we're looking at the BoJ. We've got a BoJ interest rate decision overnight at the back end of the week. That's on Friday morning here in the UK. It depends where you are in the world. But we've also got the likes of the exports and imports data coming out on Wednesday, notably that weakness in terms of imports, strength in terms of exports. That highlights the benefits of that weak yuan, Japanese yen, sorry. Then into Thursday, we've got the inflation data coming out. This is also key. You can see expectation. We see a move higher in both headline and core. And that highlights something that we have been seeing recently, which is this reflation move in Japan. And this points towards the need to ease off with those low interest rates and potentially hike once again. So as we can see here, first and foremost, we've got the two lines on the top end. The orange line is the nationwide figure, and that's what we're going to see coming out this week. The blue line is the Tokyo figure. Now, Tokyo generally leads the nationwide number. It doesn't necessarily mean that, say, this will jump to 3.1. But as we can see in the past, if Tokyo goes up, the nationwide figure generally goes up. If Tokyo goes down, nationwide will go down. This time we're expecting to see nationwide figure move higher, and that is in line with the expectations according to that Tokyo reading. In terms of the month on month, you can see roughly 0.5 up to 0.6 over the past two monthly readings. We saw that negative September figure, but then we had a pretty solid couple of months prior to that. So as we can see here, that annualized figure, the 6-month annualized in particular, we're looking at the bottom here, which is purple, at 3.5 at the moment. So certainly inflation at the moment isn't necessarily low, and it's at the point where the Japanese might think that they can raise rates once again. Now, in terms of the expectations, markets have priced in an 80% chance that we see a hike, 25 basis points. And then beyond that, where are we looking for the next hike? Well, potentially at the back end of this year in sort of Q4, potentially in September, so the back end of Q3. But this is a live meeting, and markets do expect to see a move from the BoJ. Now, if we're looking at currencies to pair it against, well, the pound has certainly been a very weak currency of late. Interestingly enough, we've seen strengthening in terms of bond yields in the UK, but we've been seeing weakness in terms of the pound. And there's a lot of concern here because it feels like it's economic weakness that's coming alongside higher inflation or potentially higher inflation. But that has been allayed recently, and we've seen lower inflation coming into play. We've seen lower retail sales coming on Friday. Well, what did that do for the pound? Didn't exactly lift it, right? So it feels like, with bond yields moving towards the upside, we saw selling pressure for the pound. When we saw weakness in terms of inflation, we saw weakness in terms of retail sales, the pound sold off again. So certainly at the moment, the trend is against the pound. It has seen quite a lot of weakness pretty much across the board. At the same time, we're looking at this sort of narrative around the potential for the Japanese to be raising interest rates. And certainly, as I'll come on to in a sec, the UK is going to be really interesting this week as well, because we do see data. And so the more weak data we get out of the UK, the more likely we are to see more rate cuts from the BOE, and therefore more weakness for the pound. And add to that, this story around a rate cut from the BoJ. As we can see on an intraday basis, see some really nice moves. That's probably a 50% retracement. That's probably a 38.2, probably a 50 there. That was probably a 61.8. Say that is likely to be a 61.8 or 50. And then another very deep retracement, pretty much all the way back up to the prior high, but now selling off once again, as you can see here, 190.228. So rolling over, the intraday trend is consistent with the 4-hour trend. The wider trend here points towards a possibility of this sort of almost double top formation. It's not necessarily at the top of a big uptrend, but certainly it points towards a possibility of some strength coming into play. And certainly if we see weaker inflation coming out of some of these other areas, so a resumption of that story around monetary policy decisions going in the way of rate cuts, that points towards weakness against the Japanese yen, as of course we're going to be looking for potential rate hikes from the BoJ with the moves that we're seeing in terms of inflation. So in terms of inflation, in terms of the BoJ rate decision, all going to be key playing into this potentially bullish narrative for the Japanese yen. And that comes at the same time as we're seeing the likes of the UK releasing a whole raft of data. As we can see here, this is the outlook for the week ahead in the UK, dominated by Tuesday's jobs report. Unemployment expected to remain as is. Employment change expected to come in weaker. Claimant count expected to decline. But crucially, we're going to be looking out for the average hourly earnings. The average earnings, including bonus, expected to decline to 4.9. The excluding bonus figure expected to decline to 5%. So if we're seeing both of those happening, that's pointing towards weaker underlying inflation pressures, and that points towards weaker inflation, which points towards the BOE potentially being able to cut rates by a greater degree. Now, this is the chart which essentially plots those together, right? So we've got total wages, which is in the sort of orangey yellow line. We've got the wages excluding bonuses, which is in the blue line, which, as you can see there, at exactly the same point at the moment. which is consistent with this. So you can see 5.2 for both of those metrics. And then I've also got the inflation figure, which is in the green line at the bottom there, which is sort of coming back up. And then we've got the services inflation, so just the services section of it. And certainly services, as you can see, elevated compared to that headline CPI metric. So the continuation of that downward trend is absolutely key for services inflation. It has been moving pretty much in lockstep with those wage figures. But the fact that the wage figures were sort of turning higher last time around, most notably the total wage figures, that was a warning sign. What we need to see is it moving down, and that's what markets are expecting. So if we see a downward move in terms of wages, then we're expecting to see that in line with the downward move in terms of services inflation. That leads into a possibility that we see wider inflation moving towards the downside. And all of that feeds into this narrative around the potential for a greater degree of rate cuts from the BoE. The chart for the BoE, excuse me, probably not the only one that's been under the weather this week. So this is the outlook for the BoE, right? So the expectation is that we see a cut in February the 6th, 82% chance of that. The next move expected to come likely in June. And then in my mind, I think we ramp up the easing at the back end of the year, because on the current trajectory, and we've been breaking this down over recent months, the heavy inflation is really front loaded when it comes to this year. So the back end of this year, we could see it ramp up, but it all comes down to whether we see inflation pressures abate or not. Now, what we've seen recently is this big resurgence in terms of borrowing costs in the UK. It's been hitting all the headlines. But notably, if you look at the right-hand side of this chart, all of this is rolling over quite heavily because of the fact that we've seen that lower inflation gauge. And we're in this bad news is good news scenario for markets, where weak retail sales, great news. That means that we've got lower inflation pressures, right? And so we've seen borrowing costs coming down, the 10-year yield, the 5-year yield, the 1 year, the 2 year, the 30-year, you name it. It's all started to roll over. And it's taking the pressure off the government because, of course, they've got a huge amount of debt that they'll need to roll over. And it's going to be at higher cost if we see the yields at the kind of levels that they have been recently. So I've inverted the FTSE 100 here, which is in the purple line. And what we can see here is that higher borrowing costs, higher 10-year yield, 2 year, 5 year, you name it, goes hand in hand with weakness for the FTSE 100. And when we're seeing it rolling over, so we're seeing strength in terms of the FTSE. So if we see weak data, if we see higher unemployment, if we see a growth in terms of the claimant count, importantly, if we see weaker wage growth coming out from the UK in the week ahead, what does that point towards? And bear in mind, we've got PMIs as well, so it's another one for us to look towards. If we see weakness on that front, that's likely to be a boost for the FTSE 100. And what's happened for the FTSE? Well, it's hit record highs over the course of this week. We're going to wrap up with the FTSE 100, and it's finally, having its time in the sun. I mean, look, if you are a holder of the FTSE 100, you have to deal with a lot of chop and not much upside, right? The breakout periods are relatively fleeting. The chop periods never ending, right? And so we've now just had essentially half a year of consolidation, but we've reached a record high, breaking through resistance. Something worth noting here is this chart here. So this is euro sterling plotted against the UK in relation to the DAX. And what this points towards is euro sterling popping towards the upside. And what this should mean is that the FTSE 100 should outperform. So we should be seeing strength in terms of the FTSE. We're not necessarily seeing that at the moment, but it does point towards the basis for strength for the FTSE going forward. So maybe this isn't just it. Maybe we haven't just popped and now we just get back into the range. It's a good chance that we continue on this trajectory. Of course, that breakout level now turns into potential support, which is 84.78. If we can maintain price action above that level, it will be key. But certainly as we look on the intraday basis, we're seeing this sort of runaway move over the course of this week, following on from the inflation data and feeding into it with each weak figure that we see out of the UK. We saw GDP coming in pretty underwhelming at 1%. We saw retail sales coming in weak at minus 0.4. All of it feeds into the narrative of a bullish FTSE 100. And with us breaking through resistance, we have no resistance levels left after hitting record highs. So this is going to be a key story as we move forward. And any weakness is strength for the FTSE 100 at the moment, because we just want to see a really weak economy that pushes the Bank of England towards more rate cuts over the course of this year, and certainly anything that points towards us seeing greater disinflation, that's good news when it comes to the markets at the moment in the UK. So bad news is good news, and it's going to be an absolutely massive week, when it comes to the inauguration at the beginning of it, the Bank of Japan with a potential interest rate hike, and the UK hoping to continue its bad run of form that has provided record highs for the FTSE 100. I hope this is useful for you guys. I've also done a preview for 3 of the top earnings that we're going to be looking ahead to for next week, following a week that's seen bumper earnings from some of the big banks in the US. And I've also provided that video that wraps up some of my views around some key markets ahead of Donald Trump's inauguration. Have a great weekend, everyone, and good luck trading for the week ahead.